We are going to read the 1957 Warren Buffett letter to partners. This is Warren Buffett's hedge fund, obviously in the 1950s and 60s, where he kind of just exploded his net worth, going from around $50,000 to over $25 million by the age of 40. I've read these letters a few times and I've always found them extremely insightful. I felt like it was time to reread them for myself, and I figured I would bring you guys along in this journey. I hope you guys enjoy it. Let's jump right into it. This is Warren Buffett's second annual letter to limited partners. This is 1957, and here's what he has to say. The general stock market picture in 1957. In last year's letter to partners, I said the following. My view of the general market level is that it is priced above intrinsic value. This relates to blue chip securities. This, if accurate, carries with it the possibility of a substantial decline in all stock prices, both undervalued and otherwise. In any event, I think the probability is very slight that current market levels will be thought of as cheap in 5 years from now. Even a full-scale bear market, however, should not hurt the market value of our work out substantially. So let's break this up. There's a lot to digest here. First off, I like how Warren Buffett provides us with insight on how he thinks. He says, in any event, I think the probability is very slight that the current market level will be thought of as cheap in 5 years from now. That's insightful because that's how he thinks about the market. He's asking himself, if I buy here, am I going to think that this is cheap in 5 years from now? I also like how he includes the fact that blue chip stocks can be overvalued because a lot of people just naturally think, if I invest in blue chips, Amazon, Apple, Tesla, Meta, where Warren Buffett is like, no, those can also get overvalued. And he kind of just says that it relates to blue chips. I also like how he tells us even undervalued stocks, when the market goes down, even undervalued stocks go down too. Another thing I really want to touch on is he's like, even if the market goes down, our portfolio is going to be okay. That gives us a way to manage our money in a market where I think it's very overvalued. He gives us the answer here when he highlights focus on workouts. I like that. And let's keep going because this is pretty good stuff. If the general market were to return to an undervalued status, capital might be employed exclusively in general issues and perhaps some borrowed money would be used in this operation at that time. Conversely, if the market should go considerably higher, our policy will be to reduce our general issues as profits present themselves and increase the workout portfolio. Awesome stuff. So he's giving us how he rebalances his portfolio, and he throws in some stuff that is super insightful that goes directly against the grain of what is preached on how to invest your money in today's world. So this is super insightful already, and we're only 2 paragraphs in. If the market were to go to undervalued, our capital might be employed, right, exclusively in general issues. What does he mean by general issues and workouts? He's going to describe later in this letter. But general issues, think of those as your cash flowing businesses. So something that is producing cash flows and putting that in the owner's pocket. And think of special situations as something that is getting the value unlocked by a corporate act. Another very important thing. And he says, perhaps they will even borrow money. It's like in the world today, using leverage, investing in stocks is like, oh my God, don't do that. And I think that this is exactly wrong. If a very good deal comes and presents itself, you should be willing to go out and leverage into it. One of the things that I've personally struggled with earlier in my career, using leverage was insane. Like people that did that were crazy. But the older I get, if you know how to read business and you know how to, decipher what a good deal is, it's not like these things come around so often. It's like when a very good deal and a very good opportunity presents itself, that's the time to send it in. That's the time to go out and make a deal. And if that requires you to go out and borrow some money to make the deal happen, that's the exactly right thing to do. So I know that a lot of people think it's crazy to invest on leverage. And at one point I did too. But the older I get, the more value I see in having that as an option, right? I don't have any investments that I'm using on leverage right now, but if a really good deal did come around and this was a cinch and I was going to make a lot of money, going out and borrowing some extra money to juice up my returns makes a lot of sense. But you have to have a little bit of experience and really know what a good deal looks like. So I think that's super important. I'm really glad that we just are hitting these points right in the beginning of this thing. This letter is awesome already. Let's review this one more time. Basically, he says, as the market goes higher, we're going to rebalance out of those general issues that are, we're going to turn good profits on, and we're going to rebalance into these workouts as the market goes higher. But if the market goes lower and these cash producing businesses get cheaper, we're going to buy heavily, even so much to the point that we'll go out and borrow some money to get extra money into these things. So I think that is pretty cool. Let's move on. Make sure. Okay. All of the above is not intended to imply that that market analysis is foremost in my mind. Primary attention is given at all times to the detection of substantially undervalued securities. Bam, love it, right? So he's saying, I'm a bottom-up investor. I'm paying attention to where we are, like Howard Marks always says, like, know where we are right now, know where you're standing. But Warren Buffett is saying, I'm aware of where we are, but at the end of the day, what matters most is where I'm putting my money, what business looks like, what that opportunity looks like. So he's not so much worried about the overall market picture and more so worried about what that asset is going to do for him that he's directly investing in. And I think that's important because a lot of people are always out there looking, oh, the market's overvalued and da. It's like, dude, the market's overvalued. But if I find something trading at a 3 PE that has a 40% profit margin and tons of cash, no debt, who cares if the market goes down? If that business is still going to make that money in a bear market, it doesn't matter. It's going to pay me many times over. That ownership is valuable. One of the things I grew up kind of worried about, oh, well, if the stock market crashes, what, I got to be ready and I got to have money to buy. I mean, it hasn't really crashed. I started investing in 2010 and 14 years later, it's like still going up. If I would have been waiting that entire time, if you own high cash producing businesses and they're returning that cash back to you, the owner of the business, that's really all you need. The past year witnessed a moderate decline in stock prices. I stress the word moderate since casual reading of the press or conversing with those who had only recent experience with stocks would tend to create an impression of much greater decline. Actually, it appears to me that the decline in stock prices has been considerably less. This means that the public is still very bullish on blue chip stocks and the general economic picture. I make no attempt to forecast either business or the stock market. The above is intended to dispel any notions that stocks have suffered any drastic decline or that the general market is at a low level. I still consider the general market to be priced on the high side based on long-term investment value. This is really insightful because what he's saying here is if you pay attention to the media, they're going to misguide you. They're not really paying attention to the bottom line of things, where he's like, I'm focused on how much earnings power am I going to get for the price that I'm paying? I don't care how much the stock market drops. Everybody else is worried about, oh my God, the stock market dropped. He's saying it was overvalued and it dropped a little bit and it's still overvalued, so it could drop a lot more. But he's focused on how much earnings power am I going to get right now for the price that I'm paying? That's how I'm going to measure if the stocks are up or down or how cheap the market is. I think that's important because if you turn on the news, just recently, we went through the yen carry trade where Japan raised their interest rates, the stock market fell 6.5% from highs. And 6.5% from highs is not that big of a move, but if you go onto social media, it's like everybody was going crazy over this. In the grand scheme of things, if you look at the Buffett indicator, US markets are extremely expensive. So keep that in mind as you invest your capital. It's a lot wiser to approach it like Buffett is recommending here, or how he did it in the past. I love looking at this stuff because this is how young Buffett was thinking, and he was way ahead of the game. I don't even see many people thinking like this now, but I think this is exactly how we should be thinking, and that's why I'm picking these up. Okay, let's continue. Our activities in 1957. The market decline had created greater opportunity among undervalued situations, so that generally our portfolio is heavier in undervalued situations relative to workouts than it was last year. Perhaps an explanation of the term workout is in order. A workout is an investment dependent on a specific corporate action for its profit rather than a general advance in the price of the stock. Workouts come through sales, mergers, liquidations, tenders, etc. In each case, the risk is that something will upset the apple cart and cause the abandonment of the planned action. Not that the economic picture will deteriorate and stocks generally decline. At the end of 1956, we had a ratio of about 70 to 30 between general issues and workouts. Now it is about 85 to 15. He gives us what a workout is. I generally call these special situations, but I also like how he gives us a ratio of how much of his portfolio is in workouts versus general issues. A general issue is usually those cash producing businesses, those cash flows, right? Whereas a workout is something that relies on a corporate action. I started investing heavily in special situations in 2022 to 2023. In 2023, my special situations portfolio, my 30%, actually returned 73%. Here are some stats, and this is why I've been so hot on special situations. First off, I am very confident that this is the best way to grow a small portfolio. Second, they turn to cash extremely quick, which is attractive because if your investments are turning to cash, let's say I invest $20,000 in a special situation event and that investment returns 50%, so $10,000 in profit. I just turned $20,000 into $30,000, but here's the real thing that's attractive is that $30,000, when I cash it out because the special situation plays through, I now have $30,000 in cash. I had $20,000 invested, and now I have a lump sum of $30,000 that I got to find somewhere to park. In 2023, we didn't have a huge market pullback, but I did always have cash on hand. It was like, oh my God. My problem was like, oh my God, I got to find places to put cash. Whereas if you're just investing in the general issues, I see a lot of people are fully invested. Well, that is not the best position to be in because the market is always going to have pullbacks. And on those pullbacks, you sometimes find really attractive situations. With the most recent pullback with the yen carry trade, everybody was talking about buying. I was different. I was not buying really anything, though I used options. I bought a lot of call spreads and bullish put spreads. And I deployed a very tiny amount of my portfolio. But I was thinking, if it does bounce, at least I have some exposure to that bounce. And these trades are all up like 30, 40%. I'm not allocating huge amounts of money to them. But here's the way I was setting myself up. If the market does bounce, at least I'll be making decent returns on some money that was allocated. And if you're using options, it's not like you're getting 3, 4, 5% options or, 30, 40, 50% moves generally if you're doing it the right way. If the market doesn't bounce because it is super overvalued, so I don't want to be in this position where I'm just using up all my bullets on the front line. I want to have a stockpile of cash to deploy if the market really does have a significant pullback, like 30%. So that's how I kind of used or positioned my portfolio. And unfortunately, there weren't a whole lot of really great special situations to get my money into on that larger pullback. There were a couple that I can think of off the top of my head that I did get a little bit of money into, but at the end of the day, that pullback was pretty short-lived. So something to think about. Definitely, if you've never invested in special situations, 100%. It is so valuable for two reasons. A, it turns to cash quickly, but B, it gives you the opportunity to build up a library of priors in your mind. Whereas long-term investors, they're so focused on, got to be a long-term investor, got to be a long-term investor. A, their annualized rates of return are much lower than what you can do in special situations. And the amount of experience, the library of priors that they're building is significantly smaller than what you can do if you are trading special situations. So in 2023, I had 11 winning trades, 2 losing trades, and I added 13 cases of experience to my mind. The long-term investor, how many cases of experience are they really adding in a year? A couple, maybe 2, 3, maybe 4, right? I added 13. So I'm getting a lot better than them in terms of experience. Paragraph. During the past year, we have taken positions in two situations which have reached a size where we may expect to take some part in corporate decisions. One of these positions accounts for between 10 and 20% of the portfolio of various partnerships, and the other accounts for about 5%. Both of these will probably take in the neighborhood of 3 to 5 years to work, but they presently appear to have potential for a high average annual rate of return with a minimum of risk. While not in the classification of workouts, they have very little dependence on the general action of the stock market. Should the general market have a substantial rise, of course, I would expect this section of our portfolio to lag behind the action of the market. So, a couple things I like here. He focuses on have high average annual rate of return. Oops. So high average annualized rate of return with minimum risk. And that is the main thing that I want everybody focusing on. If you're watching this video, it is all about annualized rates of return, preferably after-tax annualized rates of return. Special situations allow you to generate huge annualized rates of returns. Generally, let's just say if you end up finding a stock trading at a 5 PE, maybe you do average 20% per year, which is awesome. But in special situations, I've hit stocks where the annualized rate of return was like 10,000%. Okay, so I've had 100 baggers in a sense. It's rare, right? But we are finding many 200% annualized rates of return. I generally am aiming to get around 30 to 50% annualized rates of return. I almost have a standard of 50%, where if the annualized rate of return is not 50% or higher, the special situation is not necessarily attractive enough. So in 2023, I think that's why my returns were so high, because my standard of annualized rate of return, the hurdle rate was high. So just something to think about to give you a little bit of background on that. Okay, let's continue down here. Results for 1957. Just one quick thing on the controlling position. That's not going to apply to a lot of us, but it is something to keep in mind. As your portfolio grows, maybe you do find a smaller company and you're like, I'm going to take a controlling position in this. You can revert back to this letter. Results for 1957. In 1957, 3 partnerships which were formed in 1956 did substantially better than the general market. At the beginning of the year, the Dow Jones Industrial stood at 499, and at the end of the year, it was at 435 for a loss of 64 points. If one had owned the average, he would have received 22 points in dividends, reducing the overall loss to 42 points, or 8.47% for the year. This loss is roughly equivalent to what would have been achieved by investing in most investment funds, and to my knowledge, no investment fund invested in stocks showed a gain for the year. All three of the 1956 partnerships showed a gain during the year, amounting to 6.2%, 7.8%, and 25% on year-end 1956 net worth. Naturally, one question is created as to vastly superior of the last partnership, particularly in the mind of the partners of the first two. This performance emphasizes the importance of luck in the short run, particularly in regards to when funds were received. The third partnership was started the latest in 1956, when the market was at the lowest level, when several securities were particularly attractive. Because of the availability of funds, large positions were taken in these issues. The first two partnerships formed earlier were already substantially invested, so they could only take relatively small positions in the issues. Okay. Basically, all partnerships are invested in the same securities in approximately the same percentages. However, particularly during the initial stages, money becomes available at varying times and varying levels of the market, so there is more variation in the results than is likely to be the case in later years. Over the years, I will be quite satisfied with a performance that is 10% per year better than averages. In respect to these three partnerships, 1957 was a successful and probably better than average year. Two partnerships were started in the middle of 1957, and their results for the balance of the year were roughly the same as the performance of the averages, which were down 12% since inception. These portfolios are now starting to approximate those of the 1956 partnerships, and performance of the entire group should be much more comparable in the future. A lot to unpack here. The main thing is performance against the market. So he's very focused on, how does he perform in respect to the averages, so to the general market. He's like, if we can beat the market by 10% per year, that's huge. That's how we need to be thinking. If the market goes up 30%, you didn't get 30% richer. The key is the alpha. If the market goes up 30% and you do 50%, you got 20%. If the market goes down 15% and your portfolio is up 5%, you're crushing it. You just did 20% better than the market. So that's how you really need to be thinking about things. Yes, if you are invested and you're comparing yourself to people that are non-invested, right? So let's just say you have somebody that has zero assets and you do have assets and you are, the market goes up 30%. You do get 30% more rich. But if you're really trying to be in the elite group, and if you're investing, I don't care, who you are, you're investing for a reason. There are people that are playing against the poor. If you're just investing in index funds, you're playing against the bottom of the barrel. But if you're handpicking your stocks, you're playing against the people that are playing against the poor. You can beat them a lot easier than you think. Granted, it does take some work. You do have to understand the language of business. You do have to pick up things like the Warren Buffett partnership letters. But anyone watching this video and listening to this content, you are literally an ambitious person. There's no doubt about it. You wouldn't be here if you weren't ambitious. So now let's funnel that ambition and do it the right way. We're studying Warren Buffett when he was young. This guy, at this time, he's turning $50,000 into $25 million by the age of 40. This is how he's thinking. This is exactly how we need to be thinking if we want to replicate that success. I'm confident that we can replicate that success. I know I'm getting a little fired up because I love this stuff. Let's jump to the interpretation of results. To some extent, our better than average performance in 1957 was due to the fact that it was a generally poor year for most stocks. Our performance, relatively, is likely to be better in a bear market than a bull market. Deductions made from the above results should be tempered by the fact that it was the type of year when we should have done relatively well. I would be well satisfied to match those advances. I can definitely say that our portfolio represents better value at the end of 1957 than it did at the end of 1956. This is due to both generally lower prices and the fact that we had more time to acquire the more substantially undervalued securities, which can only be acquired with patience. Earlier, I mentioned our largest positions, which comprise 10 to 20% of the assets of the various partnerships. In time, I plan to have this represent 20% of the assets of all our partnerships, but this cannot be hurried. During an acquisition period, our primary interest is to have the stock do nothing or decline rather than advance. Therefore, at any given time, a fair proportion of our portfolio may be in the sterile stage. This policy, while requiring patience, should maximize long-term profits. I have tried to cover points which I felt might be of interest and disclose as much of our philosophy as may be imparted without talking on individual issues. If there are any questions concerning any phase of the operation, I would welcome hearing from you. Let's go over some key takeaways from this letter now that we're finished with it. So, number one, I'm writing with a highlighter. Let's write with the pen here. So, let's do main takeaways. Number one, when the market is expensive, we want to focus on special situations. For every reason I mentioned earlier, that's the goal. Market gets expensive, focus on special situations. Market gets cheaper, focus on those cash flows because we're going to get higher rates of return. Number two, think bottom up. We want to be thinking bottom up on our investing. Don't worry so much about what the overall market is doing. There are opportunities to find great investments in any market environment. It doesn't matter if the market is screaming higher. There are cheap stocks available right now. There are high quality investments right now, even though markets are extremely expensive. Don't let the fear of the market coming down keep you from getting your money into high quality investments. That's something that I had struggled when I was a little bit younger with. Number three is just, know where you are. Just be mindful of where you are and where the market is. I think that's super important. How do you do that? You do that by focus on the fundies, right? So like what are the prices of these things? So it's like focus on fundies versus price. And that's important because you can't just blindly invest, right? Just because the market is down doesn't mean it's cheap. It might be cheaper than it was, but the real way to determine how expensive the market is to compare the fundamentals and the earnings power to the price that you're paying, which not everybody does. Number four, which is super important, is we need to focus on alpha. We're not trying to just ride the wave with the market. We're trying to beat everybody. So like I said, there's kind of three levels to wealth. You have the poor, and they just don't have assets. And then you have the middle class, and they are just like index fund people. And then you have like us, the elite. It's like we're trying to destroy the middle class as much as possible. It's like get as much alpha. We're alpha seekers, right? Seeking alpha. So that is why we're doing this. And honestly, like it's almost like rooted. For me personally, it's like rooted. It's It's like protecting myself and my family. How do you do that? Make sure you always have enough money. It's a valuable resource, like food and water. To me, I don't know if everyone else is like that. Number 5 is don't chase, right? You don't have to chase things. Let deals come to you. And when they are good, bet big. Go use leverage. If it fits like a glove and it's going to really explode your net worth, don't be afraid to borrow some money to make the most out of that opportunity. So that's it for this one. I hope you guys enjoyed it. If you want to get access to the Buffett partnership letters, comment below Buffett letters or DM me Buffett letters and I will send you a copy. Peace.